It took me a very long time to understand the simplicity behind this trading model that I'm about to show you guys in this video today. So if you are interested in this kind of content, stick along because this video is going to teach you a lot about fair value gaps and is going to be very brief and straight to the point. What's good, everybody? My name is Gislen and you're watching the Forex Hybrid. This is the fair value gap trading strategy, all right? Fair value gap trading strategy was introduced by ICT himself. ICT is one of the greatest traders out here and he's been in the game for a very long time. Probably he started trading before I was even born. You feel me? So he's a veteran when it comes to like trading and stuff. He is a veteran in this whole industry. So this is a concept that he has been on for the very long time, but it took me a while to understand the physics behind this concept, to understand the math behind this concept, to understand why this trade or why the market moves a certain way. You know, everybody has their own ideas of how the market moves or why the market moves or why the market does certain things, but your idea does not really matter. You know, at the end of the day, you just have to make money. What I've understood and what I'm about to share with you guys here is fair value gaps work. Fair value gaps, they work. Nobody should tell you that they don't work. They work. But now the problem is there's a lot of fair value gaps in this market. On this particular candlestick, let's look at this price leg. Look at this price leg from here to here. This video is going to be very practical. There'll be less talking and more of showing. You feel me? So that's why you should subscribe to my channel. So you can see here, this is a fair value gap. If you don't know what a fair value gap is, pause this video, go and research on fair value gaps, then come back. I don't have time to explain. All right, that's a fair value gap. This is a fair value gap right here. Right there, that's a fair value gap. Right here, this is a fair value gap. On one price leg, this is just one single price leg, we have already 3 valid fair value gaps, and they're valid. All right. All right, so let's see. Now I'm going to show you guys what makes a fair value gap valid and what makes it invalid, and which fair value gap should you trade. You feel me? There's high probability fair value gaps and there's low probability fair value gaps. You get, and there's invalid fair value gaps. However, I'm going to show you guys all the different types. So first off, I'll start with invalid fair value gaps, then I'll go to low probability fair value gaps, then lastly the highest probability fair value gap. So you want to stick around and watch this video till the end. Beautiful. Let's get into it. An invalid fair value gap is simply a fair value gap that resides on the wrong side of the current price trend. Okay, so if a fair value gap is found on the other side of the trend, for instance, let's say this is a price trend and this is clearly a downtrend. This is the current price trend. Okay, the price is trending downwards. Then let's say the fair value gap resides somewhere around here. This is an invalid fair value gap. It is invalid because it is found on the wrong side of the trend. If price is above this level and you see a fair value gap there and you're looking to buy this level, buying this trade here is like you trying to force the market to start pushing up from here, which means when the market enters this gap, you expect price to continue up. It could happen, but that's you telling the market to do it, but the market does not care what you say or how you feel about it. So the high probability or the best way to trade fair value gap is using or following the trend. If the market is trending downwards like so, instead of the fair value gap residing on this price leg, which is the pullback phase, it should reside on this impulsive. If price can reside somewhere here, you know, okay, when price is pulling back, then you tap into that fair value gap and then continue the run down. You can only look for buy fair value gaps or buy fair value gaps when the market has changed character to the upside, or if the market is in a constant or consistent uptrend, then you can look for buy fair value gaps or selling fair value gaps, which will reside somewhere around this price leg in the premium area of this price leg. All right, now let me show you guys on real price charts. Okay, so here's an example of an invalid fair value gap. Fair value gap that is not really needed, but it's there to trap you into entering a trade. Yeah, so now let's do it. Right, you can see the market here trending down. You can see this movement. This is a downtrend and price is pushing up and pushing down. Now this price here is in a downtrend. This is still a downtrend. It's still continuing down. In as much as we have a valid change of character here, this fair value gap that resides here is invalid. Why? Because this trend has not shown any signs of upward momentum yet. You can see here that even when the price was breaking this area, there's a lot of consolidation and indecision here, which means the price is not quite sure where it's downtrend. We have a fair value gap right here. Let me delete this and zoom in more. We have a fair value gap right here. This is the fair value gap right here. We stretch this all the way through. You see that this fair value gap was tapped into here and actually had a reaction from it. It was invalid and price pushed down powerfully. Like if you look at this thing, this is a powerful push. Like look at this. After people have already bought here, you can see how impulsive the market was to the downside. Can you see how the market was struggling to enter this level, but when it tapped, it struggled, then it was just so easy breaking down. And now let's look at another fair value gap here that resides on the right side of the market, which is a good fair value gap like this one. You see what happens? Because now we're following the trend. So an invalid fair value gap is simply a fair value gap that is against the trend, against the current price trend. Now let me look for another example. Let me show you. This is example 2 of an invalid fair value gap. Now this fair value gap here is invalid because price is pushing down consistently to the downside. This is a clear downtrend, and you can all see it. You can see price try to push and break above its highs, but fail to do so. Now this is an invalid fair value gap. This push here you see here, you think it's a change of character. It's not. It's simply a pullback. It's a very, very powerful. That does not put us in the buy trend just yet. This is still a downtrend until price makes up a higher low and then another higher high. Then you consider yourself in a bullish market. If that has not happened, you are still in a bearish market. So don't see it and be like, oh, it's a change of character. No, it's not. The second this high has been taken out, it's a change of character, but it doesn't mean we are bullish. No, it's still a bearish market. So this value here, this fair value gap is wrong. You cannot trade here. However, if you follow the fair value gaps that align with the market trend, you will win. Let me say 80% of the time, you will win. You will win. There's fair value gaps everywhere in these markets. This is another one. But it doesn't mean we'll trade it. No, I'm just showing you that it's there. Look at the top. Perfect. Even this one, you have to even trade here. You still make money because you put your stop maybe somewhere around here and the price continues down. That's how it is. Now let's go to low probability fair value gaps. Okay, guys, so this is the low probability fair value gaps. I want you guys to pay attention here. Pay attention, give me your ears, okay? These are fair value gaps that align with the current price trend, but do not meet the law of demand and supply. What I mean by the law of demand and supply is the first law of demand and supply, which states that at lower prices, more goods are demanded. At higher prices, more goods are sold. Do you understand? Which means when price is low, consumers tend to buy more. It's just like going to the provision store, going to market, and and you're told that okay, the prices of, let's say, meat has dropped. It has dropped by like 20 or 30%. There's a 30% discount on chicken. Instead of buying maybe 2 chicken that you normally buy, you might just be like, okay, let me just buy 10 because I don't know what may happen tomorrow. Price may go up tomorrow. It's cheaper today, so I'll buy more. You buy 10 chicken and stock your fridge. Now, on the other side now, for suppliers, all right, if the prices of chicken drop by 30%, they will hold their chicken and not sell it. Instead, they want to sell their chicken when the prices has increased, let's say by 30%. There's a 30% increase in price. That's when suppliers want to sell their chicken because why? They're going to make maximum profit. So on both ends, everybody is trying to win. Everybody's trying to make money. You get? The other person is trying to make money. The other person is trying to save money. So that's just how demand and supply works. Now, let me show you guys some real chart examples. So this is an example of a low probability fair value gap. This fair value gap is actually resides on the right side of the market. You feel me? Now it's one of those fair value gaps that you look at it and you're like, which fair value gap should I take? You feel me? So inside those fair value gaps, or like I quoted an example here in the beginning of this video. I quoted an example and I said there are 3 fair value gaps here. 1, we have 2, we have 3. Which one are you trading? Only one of these is a high probability fair value gap. Sorry, they are fair value gaps, but they are low probability, which means the chances of them working is low. Okay, now I'll explain why. This is why these fair value gaps are most likely not going to work, or even if they work, just maybe a small push. But sometimes they do work though. But the high probability fair value gap is always the fair value gap in the premium. Okay, I said something about demand and supply, right? I said at higher prices, consumers look to sell more, all right? This is a fair gap. This is a fair value gap right here. Let me highlight all the fair value gaps. That's a fair value gap. This is another fair value gap right here. Now we have three fair value gaps on this particular price leg. Now, what are the stages before even identifying the fair value gaps? You need to identify a clear break of structure. After identifying a clear break of structure, you want to see volume, you want to see impulse like this. All right? When you see this, you want to see fair value gaps. When you see fair value gaps, you want to see the high probability fair value gap. How do you know? High probability fair value gap are fair value gaps that are above the 50% of the Fibonacci. Let me draw my Fibonacci. This is my Fibonacci tool. You draw from top to bottom in a downtrend and from bottom to top in an uptrend. All right. So this is a downtrend. I draw from top to bottom. My Fibonacci might look different from yours because I've made some custom settings on them. All right. So let me show you guys the custom settings. These are my settings. You can go ahead and pause this video, screenshot it, or you edit yours. If you want to use my settings, you can copy them if you want. So coordinates, I think so, visibility, everything is that. There you go. So that's my setting right there. You can use it to have your Fibonacci look like this. Now let me explain why I made this Fibonacci and how you can use it to your benefit. All right. Now we have three colors on this thing. Three major colors. This pink zone is the sell zone. This is called premium. All right, the golden zone here is basically the midpoint. It's the midpoint. This zone here also, it's good for buying and it's also good for selling. Like it's just the in between of both. You feel me? But it's mostly for average setups, A plus setups. This is it, A plus setups. But this middle part is for like B plus. It's for like B setups or like category B setups. You feel me? It's in this pink zone or in this area. Now in the downtrend, you want to be selling in this pink zone. Like I said, this is premium and this is discount. So when price is in a downtrend, therefore we are selling. So when we are selling, we are suppliers. And when we are suppliers, we are looking to sell at the highest price. Okay. So in trading, you're two people. You're either the buyer or you're the seller. So in this case, we are sellers. Why? Because the price is trending downwards. Now that we are selling, we want to sell at a good price. Selling here might be profitable, but it's preferable we sell higher than this so we can maximize our profit. So this is the fair value gap that resides in the premium zone in our price leg. So it might not make it there. Sometimes it does. If there's a fair value gap in the premium, always go for the one in the premium. All right. Now let me delete the Fibonacci so you can have a clear chart. I don't know, I'm catching cold, so I need to clear my throat. I'm sorry about that, guys. All right, so this is a fair value gap. All right, beautiful. Now look at observe price here. You can see price pushing up impulsively. It just ran through this one. You can see the first push here, it entered here, it tried to go down, it came back, consolidated here a little, then it swept all these levels. Imagine selling here and selling here. It swept all these levels and it came straight for premium. Now when price entered premium, suppliers jumped in. Suppliers like you and myself jumped in and pushed the price down. I'm not saying that we're the ones pushing the price down, but I'm just saying like there's huge institutions, there's huge volatility. There's a lot of orders being placed at these particular zones. So all of that causes the market to crash because of the heavy, nice. So right there is our trade. Let me show you guys another example of a low probability fair value gap. Okay, so just next to this one, you can see this price leg here. I want you guys to pay attention. Look at this push from down to up, right? Now, what do we see? First off, we see a break of structure. That's the first thing we look for. We identify a break of structure. We identify what? We identify momentum. Is this a is it a very powerful break, or is it something like this? When it's something like this, it's pointless. When it's something like this is momentum. This is impulse. This is what to trade. Why? Because when price moves with such power, with such speed, it often leaves behind fair value gaps that will come back to fill. When price moves like this, most of the time this is efficient. Why? Because in this market there's a lot of up and down movements, there's a lot of consolidation, and when the market is consolidating, it essentially fills back all the gaps that it leaves behind on smaller time frames. You get so on when price moving out with huge candles like this, it's almost difficult for price to like fill up all these gaps on its way up or on its way down. So you leave it, then come back shortly and fill it. Now we have I think we have three fair value gaps on this price leg as well. Let's identify them. We have one fair value gap all the way up here. Sorry guys. We have one fair value gap all the way up here. This is a fair value gap right here on this candle. I don't know if you guys. This is a fair value gap right here on this candle. Right? This is another fair value gap right here. That's another gap, and then this is the third one here. Now, in this market condition where price is taking out the highs, this first of all is an uptrend. If I identify the trend to be an uptrend, so that means we are buyers. And when we are buyers, what do we need to do? obeying the laws of demand and supply. What are we supposed to do? When we're buyers, we're looking to buy the market as low as possible because why? We want to save money. All right. Everybody's looking for profit. Good. So if I want to buy this thing, this particular currency pair as low as possible, I'll use my Fibonacci to measure what? The premium and the discount. So I'll draw from bottom to top. Bottom to top. Don't leave out the week, it's very important. Then now we look at this. Look at where the fair value gaps are residing. We have two fair value gaps in the discount zone. We have one in the golden and the premium zone. Now, this pink zone is what we want to buy from, right? We are buying here with two gaps. Which one are we trading? Preferably, I'll take the one down, even though this one too is in the premium and you can trade it as well. But I'll take the one down. Why? Because they're kind of close to each other, so you can treat them as one as well. You can basically put maybe an entry somewhere in between both, or you just take the one down and put your stops just at the low right there. You can see like that. So that is how you can treat that particular level. You can trade it like that. If we stretch this out right there, you can see the push right here. It might not be a significant one, but this push here can give you like a 3 hour, a 2 hour, sorry, and 2 hours is pretty good. So let's go now to high probability setups. As a matter of fact, I think we've already gone over that. You know, we did a low probability and a high probability at the same time. So that is it. I hope you guys picked out something for this video. My teaching might be a little off, might be a little shaky and stuff. I'm a forex trader, I'm not really a teacher, but I try my best to explain things the simplest way possible so you can understand. Okay, so there you have it. If there's any questions you have, leave them in the comment section. I'll be checking all your comments. I'll see you guys in the next one.